Bankers reveal the worst is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the latest banking report shows a shocking reason why bankers now believe that we are months away from a major credit crisis, one that could rival the global financial crisis. We're going to take you inside this report to show you why they are panicking, why they're so worried, and yet we're hearing on the other end from policymakers, from the mainstream media, that actually we're headed into just a soft landing and there's going to be a second half rebound. We're going to look at this report and show you why that is not the case at all, why we are indeed headed into a credit crisis, and why there's nothing we can actually do about it. And wait till you see the real reason behind it. You're not going to believe it. Plus, we have a sponsor for today's show. This is an enterprise-level software company that's making big moves in the AI space. And right now, anything AI-related is really getting the market's attention. So we're excited to have them as a sponsor. Now, I mentioned yesterday, there's a twist to this because we're doing something and they're doing something we've never done before. They're making an exclusive offer to the viewers of this show. So stay tuned to the end. You can also check them out in a pinned comment and in the description below. Let's head over to Bloomberg to pick today's story up, because again, you don't want to miss out on this opportunity, because now let's take a look at what's going on. The Fed says first quarter loan standards have tightened, demand is weakened. Now, we started talking about this yesterday, and this is really critical because I want you to understand as we go into today's story, money is created through the banks. When banks lend money, money is created into the economy. That money is used to expand the economy, support asset prices, create wealth. So it's really critical. And anytime we see the opposite starting to happen, well, and throughout history, it starts to pave the way for financial crises, recessions, credit crisis. And if you start looking around at what we're seeing with the banks lately, and we look at some of the economic data from around the world, we see what looks like air pockets. Well, we can look right here, right today, and see what the catalyst is. The proportion of U.S. banks tightening terms on commercial and industrial loans for medium and large businesses has now rose to 46%, up from 44.8% in the fourth quarter of last year, according to a Fed survey released yesterday. And we talked about this kind of going into yesterday's show, but I want you to understand we're taking this now to the next level because we're going to make the case of why a crisis is coming. Here we can see the net percentage of domestic banks tightening standards across all commercial industrial firms. You can note with the red dotted line, we are at levels that actually nearly matched the dot-com bubble, and we were fully on in the global financial crisis level. And of course, the pandemic, which is a one-off issue, but nevertheless, you're seeing we are at crisis level with this lending standards, and it has broad repercussions for the economy. It tells us we are about to see a big deflationary blow coming in a matter of months. Let's keep digging into this report, because this confirmation of tighter lending standards pushes recession odds even higher. Now, I'm going to take that and suggest that it means a recession is coming, because when we go back and look at that last chart, let's do that here. What do you notice? That every time banks tighten lending standards, what do you have? A recession. So we know this is coming, and he says nothing is a guarantee, and he's right, it's not, but the odds are hard to argue against. And yes, that is correct. The probabilities that we are going to see not a second half rebound, not a soft landing, but a recession at the very least, and an all-out crisis is extremely high. But the catalyst here, everyone thinks, this is what you hear from the media, this is what you even hear from policymakers, this is the Fed that's behind this. They actually take credit for it in a sense, but it's really not the Fed at all, as you'll see on this next chart. We'll take that chart. We're going to overlay the federal funds rate in green. I'm going to keep that red dotted line there just for reference. And I want you to note that anywhere below this horizontal black line, that the net, what we're seeing is banks lending standards E. So it's above the black line we care about. And notably, you can see the Fed raises rates here in the mid 90s. And of course, banks continue to ease standards. Here you can see in 2004, going in 5 and 6, the Fed's raising rates, and standards, at banks, they don't tighten them until the Fed actually starts to pause. You see that again, 2016 through 2019, banks on net were easing. In fact, even ahead of the Fed tightening cycle, banks still ease. So the notion here that the Fed had anything to do with this, well, that's a misnomer. We're going to show you what the truth is, but let's keep going here. The report also showed much weaker demand for credit. Now, this is kind of obvious if you think about it. If you can't get credit, or you already know, right? Maybe you want to buy a new car, but you know you're not going to qualify. So what do? You don't go down and shop for one, and you don't fill out a credit app. So in turn, when people know that credit conditions are tightening, they just don't fill out those applications. Now, if we go back a couple of days into the story, what did we hear? A big surge in credit card usage. Well, if you can't get the loan you want, well, maybe you can tap your credit card, and as we kind of suggested, that was maybe one last hurrah in the economy and the credit cycle. Well, now you're seeing why it probably is. The share of banks reporting weaker demand for commercial and industrial loans among large and mid-sized firms rose to 55.6 in the first quarter, the highest since 2009 during the global financial crisis. And that is actually dangerous, as the share of banks that are tightening loan standards rose late last year to levels more typically seen during recessions, as I just showed you, largely as a result of higher borrowing costs sparked by the Fed's rapid interest rate increases. So here you can see the media saying, look, this is all due to the Fed. And as I pointed out, that's why I wanted you to see that chart, has nothing to do with the Fed. Because if the economy is booming and rates are rising and people are making more money and prosperity is on the horizon, they can handle higher interest rates. Now, if the economy is slowing and rates are rising, now you have the problem of why you can see higher rates slow down credit creation and slow down the economy. But again, it's not the Fed, and that's one of the challenges here is, again, the Fed takes credit for it and the media believes it too. The poll, known as the Senior Loan Officer Opinion Survey, or SLOOS, showed banks cited lower risk tolerance. Well, that's pretty obvious given what's going on with the banks right now. A dimmer economic outlook. Well, the data suggests the global economy is indeed slowing, and worsening industry problems as a reason for tightening credit in the first quarter. Of course, it's easy to tighten credit when you're concerned if your bank is even going to be solvent tomorrow. So it's a lot of people aren't wanting to borrow, and the same thing, banks aren't wanting to lend because they're trying to get assets back, and that is a critical problem here, major industry problem. So we're going to expect that what we're seeing in the report today with tightening lending standards is actually going to get worse, could likely eclipse what we saw during the global financial crisis. And of course, we know back then asset prices came tumbling down. Now, I want you to think about this as we go into the next chart, because I'm going to give you kind of some insight here. If we go back to the pandemic and what happened, there's this massive influx of money into the economy, and that caused asset prices to go up. Now, what do you need to support asset prices is you need more money in the system. So if you have a withdrawal, now again, we did get rid of the pandemic support. So where do we then turn for money creation? Well, you turn to the banks, and then you turn to the bond market. And everyone believes that rates now have to rise, but here's what I want you to be thinking. If rates at this level is not creating lending demand, then higher rates are not. So the idea that higher rates are going to create more money, well, that's where we see rates fall during periods where banks tighten lending standards to get banks to not only ease them, but get customers in to borrow money. So let's check this out. Because here's what we're seeing now is that same chart with the net percentage of banks tightening lending standards for commercial industrial loans across all types against the 10-year treasury yield. And what you can note is, again, as the blue line moves above the horizontal black line, banks start tightening, and you can get higher rates as people buy into that narrative. And then look what happens. The bond market says, look, if you want asset prices to stay high, if you want this economy to stay intact, rates must come down. And you can see that over and over again, that rates start to fall. Now, you'll notice they've started to fall a little bit here, and this is one of the challenges, because what do we typically see when the banks tighten lending standards? Well, that's the Fed starts to cut rates and bring them down. And if the Fed won't do it, well, asset prices start to fall and the economy starts to recess, and then rates come down, and they come down in a big way, because again, if all else fails, money creation has to come from somewhere. And if they're not coming at current rates, then rates have to come down in a big way. And here into the report across bank size categories, major shares of the largest banks cited expected deterioration in credit quality, deterioration in collateral values. None of these words sound good, and a reduction in risk tolerance is important reasons for expecting standards to tighten for the remainder of 2023. So here we are at crisis levels already. What we've seen in lending standards and what we're hearing from the bankers are, look, this is going to get worse. There's nothing we're seeing today that says we aren't going to keep tightening standards, which now puts us months away from a financial crisis, a credit crisis, a liquidity crisis, maybe all of the above. And you can see it here in the report. And major shares of other banks reported all the same reasons for expecting to tighten as the largest banks, and additionally cited concern about their bank's funding costs, liquidity position, and deposit outflows. This is serious, and again, leading with what we know is likely to head to a crisis. And now we're going to go back to a report on Monday, which validates what we've just seen. Fed flags concerns over credit tightening and financial stress. If we're now going to look at the financial stability report that says concerns about the economic outlook. Obviously, not second half rebound, second half recession at best. Credit quality, funding liquidity could lead banks and other financial institutions to further contract the supply of credit to the economy. When they do that, as we showed you yesterday, what do you see? The money supply decelerate right now, which is unusual. Historically, it's contracting. That's not good for banks. This is not good for asset prices, not good for the economy, not good for unemployment. A sharp contraction in the availability of credit would drive up the cost of funding for businesses and households, potentially resulting in a slowdown of economic activity. No Fed, not potentially leading to a slowdown in economic activity, an actual slowdown in economic activity, which we're starting to see. That's why we look around the world. We're seeing these air pockets. We talked about what's going on in Germany in yesterday's show. We're seeing all of these real things happening. Now, the question is, what is the truth? Why is this happening with the banks? Why are they tightening lending standards? Well, it all comes back to the bond market, not the Fed, but the bond market. And here we can see, taking that same chart as before, but now overlaying the yield curve, which is a 10-year Treasury minus 2-year Treasury yields. And what we're seeing is anywhere now below the black line, where you see the red below the black line, that's saying there's an inversion. But what I want you to note is banks start tightening lending standards when that red line gets really close to the black line. So what that's telling us here is 10-year yields and 2-year yields are getting close together. Now, banks borrow at the short end of the curve, the front end, and lend at the long end. So if there's compression between the two, that means for their profit margin, well, there isn't much. And so they start tightening lending standards. And next thing you know, recession on its way. Here we can see, looking at 2006, 2007, banks started tightening lending standards. Following that, we see before we got to the pandemic, it was already starting to happen. And now all of a sudden, what happened? The banks started tightening as a yield curve compressed. And now we're seeing it inverted in a major way. And that's how we know this isn't going to get better, because even if we see rates fall, the curve is going to remain inverted. Banks aren't going to lend. So now do you see the two come together? The outlook on the banks are saying, look, we don't think we're going to lend here a whole lot, and the yield curve is saying, no, you're probably not. And that's the other issue. We know rates are coming down at some point, and as still though, they're going to remain inverted due to already the steepest inversion we've seen around. So what does that mean should happen next? Well, if you were the Fed chief, we can tell you what you should do, because Jerome Powell faces the lowest public confidence for Fed chairman on record, according to a recent Gallup poll. And what do they say? Confidence of Fed generally follows the health of the economy. In April 2020, just after a month of the onset of COVID-19 lockdowns, confidence in Powell was at 58%, the highest approval of any Fed chair since Alan Greenspan in 2004, and that is huge. So if you were the Fed chief right now and you knew the curves were inverted and you knew lending standards are tightening, what is the one thing that you could do that would make a difference? And if your answer is, I would cut rates, get that curve steepened, get those front end of those rates lower to help the banks, you've got it. And guess what? The Fed isn't doing it. They just raised rates, and it won't be till June where we find out if we're even getting a pause. Of course, they're acting like they could still raise rates, but you can see the problem here is all about the Fed not releasing the bond market from the trap that it is now stuck in. Of course, we know the Fed is to blame. And the other problem with the Fed is, you look at this, you see headlines like this from Zero Hedge: U.S. bank run escalates, deposit outflows top $360 billion in the last 3 weeks, suggesting that what is going on in the banks isn't going to get any better. It all sets the seeds of what is likely going to be a crisis that will rival the global financial crisis. And now with that, I want to introduce you to our sponsor for today's show, Edge Total Intelligence. They are an enterprise level software company that's doing some big things in the AI space. Now, I mentioned to you that there's a bit of a twist, a special offer that they're doing. We've never done this before. They've never done this before. First, let me introduce you to their website here, edgeti.com. We're going to talk about how they're integrating ChatGPT and other AI into their products, what their product is. Before we get to their special offer, here's how you can find them on the TSX. If you're in Canada, symbol CTRL. You're in the US on the OTC, UNFYF. Now keep in mind, if you are in the US, you may have a little trouble trading them. They're not fully approved on the DTC platform yet. When they are, we'll let you know. So some of you may be able to trade it, some of you may not. So if you can't, just hang tight, put it on your watch list, and we'll let you know. So what is the special offer they're making? Is they're going to answer any questions you have about their company, their stock, you name it, they're going to answer it. And all you have to do is in the description and in the pinned comment, we'll show you the link later in the show, through their email address. Don't send it to me, send it directly to them at ir@edgeti.com. Here we have it, ir@edgeti.com. Oh, I'll flip it over for you so you can see that. And they're going to answer any question that you actually have about what's going on with their business, and they're going to publish it on their YouTube channel for everyone to see. We'll let you know when they do that. And I told them you could send them a whole bunch of questions. They said we can handle it, so you know what to do. You want to interact with them, get your questions answered. We'll head over to their website, ir@edgeti.com. Now, who are they? What do they do? Well, they have a really neat product that does everything you need when you need it on one screen. Now, what does that actually mean? Well, you remember back when the remotes used to be fairly uncommon. I remember when TVs had knobs, even when I was a little kid. Nowadays, people have all kinds of remotes. And what did the world create? Well, software packages that integrated those remotes so people could have one spot to access all their technology. Well, now at an enterprise level, this is what EdgeTI is doing. They're taking all those software packages that everybody has in the company and needs access to at varying different levels and putting it into one screen, seamless integration, and they're even going to the next level of adding AI to it. Let's take a look here at what they're doing. And you can achieve the impossible, they say, as business executives require accurate, real-time, decision-ready data provided in an easily consumable manner to drive strategy, set goals, automate processes, and achieve business outcomes. Meanwhile, IT leaders need quickly and easily enable these requirements while tackling the reality of multiple single-purpose, siloed systems and data that are often redundant and cannot deliver the necessary insights into useful, explainable formats. And many IT people say they have like 80-some different logins. I used to work 20 years ago as a network admin, so I get it. You've got all these different windows open, all of these systems running, and now due to EdgeTI, you can bring it all together under one roof. Here's an example. You've got all these different platforms now, one single login, everything you need on one screen and top to bottom, so everybody in the company that needs access can get the data they need. And they're solving real world problems by extracting and aggregating operational and management data from disconnected systems. Again, these are systems that were never intended to talk together, and thanks to EdgeTI, they can communicate, use the same data source. It's powerful stuff they've got here, while providing automated workflow pipelines to orchestrate specific tasks across business and IT systems. Again, symbol UNFYF on the OTC. And now let's take a look deeper here, because they're bringing in AI, and AI is really powerful. We know right now ChatGPT is super popular. Anything AI related is getting the market's attention. Let's see what they're doing, because they can seamlessly integrate this with their clients with a click of a button, and that's super powerful. When you combine EdgeCore's ability to write back to applications and data stores, ChatGPT can find the right answers, and EdgeCore can propagate that knowledge in the appropriate format to multiple applications automatically. So imagine this, that you could integrate AI into your company with this software immediately, seamlessly, and get everything talking together at once is super powerful, because with Edge Core, you can now introduce the power of ChatGPT to any of your enterprise applications without making any changes to the applications. Can you imagine that? The power of that. Obtain real-time insights based on information within one or multiple applications, store the result on one or more solutions, and take immediate action based on the knowledge gleaned from ChatGPT. Again, a powerful tool, and it's not just ChatGPT. They're not limiting themselves. They've got even more AI stuff they're adding. So what you're seeing is executives all the way at the top that need real-time financial data on the company across multiple systems. They can get it. You've got managers that need sales data or customer support data. They've got it. You've got IT people that need to know what's going on with the systems, and you've got all that information there. And ChatGPT can not only help identify, hey, this is a problem, we're seeing some errors on maybe one of the server, here's what that means, and here's some solutions. If you've been in the IT space, you know you can spend a lot of time troubleshooting, and their technology makes it easier. This thing runs all the way from the top all the way down to customer service to make life at the corporate level much easier. And what's really cool from an investment standpoint is they're 52.8% insider ownership, and they're looking to take their stock price higher. That's one of the reasons they're featuring on our show. They're really excited about what we're doing here and looking to see what their stock can do, as of course, once they become DTC available, the word gets out that they're integrating ChatGPT in their platform seamlessly. We think that this stock could do really, really well. And they're preparing for growth as they look to invest in sales and marketing and adopt new products to make it easier for customers to integrate their product and more AI technology. So if you have questions about that, ask them directly. For sure, they'll be able to answer you at ir@edgeti.com. And as with all of our promotions, we're not suggesting you make any purchases of their stock. If you feel that it is in the best interest of your portfolio and based on your research, well, we'll put some links in the description below. We've got that email address. We've got their YouTube channel. We've got the Yahoo Finance, so you can do some research into their news. If you feel it's your benefit, well, we'll leave that decision up to you. Again, symbol on the OTC, UNFYF. We'll let you know. If you can't get it, we'll let you know when they're DTC available so you can add them to your portfolio. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.